was talking about with the community guys when we were having a check-in this morning is that the most key round number for gold right now is 5,000. Until you make 10,000, it's the most key number. You have 1,000 and you have 10,000. In between those two, 5,000 is the most significant level. And derivatives, my friends, are all about pegging.
Market analyst Francis Hunt says the most important psychological level for gold today is $5,000. According to Hunt, major round numbers drive market behavior, especially in derivatives markets where price pegging around key levels often occurs. Between $1,000 and $10,000, the $5,000 mark represents a powerful midpoint that can influence trader positioning, options flows, and momentum strategies. Hunt explains that large institutions and leveraged players frequently target these milestone prices, amplifying volatility. As gold approaches $5,000, investors should watch derivatives activity closely, as breakout or rejection at this level could define the next major trend. Now, we present the clips from Francis Hunt's interview. Before we continue to discuss this, please subscribe to our channel and activate the bell icon for timely updates. Thank you, and enjoy the video.
There are two red lines here. So we're showing you the whole gold market. And isn't it fascinating that we're coming on to the last, one of the last days? It's not the absolute last because Monday is 23. So expiry is going to be Tuesday if it's 24. And while that was happening, we're on this $5,000 line. You see this $5,000 line? That's right. So you've got a $5,000 line and you are squeezing Japanesey on the $5,000 line, and you're in a situation where you're very, very close to options expiry. The other thing that's very interesting about this level is the following. It's also the 50% level of the entire slap-in-face event. Yes, that's right. So that was 100% right up top there when we were at about 5,600. What was the final high? I think it was just shy. Final high was 5,597 on Tickmill. On others, it was 5,600. And the final low was 4,402. So 4,4 from 5,6. It's quite some fall, it has to be said, even for gold. So it was about 1,200. You add 600 on 4,4 and you come all the way back to 5,000. That's right. 5,000 is the key level. And something I was talking about with the community guys when we were having a check-in this morning is that the most key round number for gold right now is 5,000. Until you make 10,000, it's the most key number. You have 1,000 and you have 10,000. In between those two, 5,000 is the most significant level. And derivatives, my friends, are all about pegging. The concept of pegging and why we have as one of our golden rules in HVF method, that's Hunt Volatility Funnel theory and method, is that you get key levels of significance, particularly in round numbers, and there's interesting price juxtapositions around that. And that's pretty much what we're having right now. So the most seminally large, significant gold level, $5,000, is showing itself to be that case. You're having a squeeze around it, very low volatility as it was this morning. And we were inching our way back in. We've been talking about it being a good thing. This is against the dollar, by the way. I'm going to be showing you gold against other crosses, and there will become a reason for that in a minute. So gold looking generally very, very good. One of the most unique and interesting things about the fact that we are volatility focused is that we get the key levels of significance, the 50% fib, 5,000, you can see it there, 5,162. We get the key round numbers all running through here, and you can see it right there. And we also observe where the market reacted. You had a huge reaction here. You can see this hammer, boom, all the way back. You broke it. That was at this round number. That's 5,085. It's that number over there. So around almost 5,1. You can see you just kissed it there. So you had a very volatile dip here. Then you had the same level of dip, but not nearly as volatile or as deep. So you had a flatter dip. In the end, it came here. Again, that also just ran the 5,085. And now you're getting the least volatile of all three, currently working its way up, in our opinion, on balance of probabilities, likely to reach the 5,085. And what you essentially have is, and I was describing how it's actually a short jump from a triple bottom. You know, if you say to a traditional technical analyst that's a triple bottom, it isn't. They'll tell you this is a triple bottom, where you come down and you bounce on the lows 3 times, and they're pretty much the same, ideally on the same horizontal plane. Now, when you do volatility constrictions and you say, well, the first one can be super volatile like that, the second one can be medium volatile like that, and the final one can be low volatility like that. And you start to get the DNA of the upside HVF. That's right. There's a grind line that runs through, no longer a horizontal line. So it's volatility, sharp down, church steeple, then an everyday Swiss chalet, and then a much more flattened house roof for maybe, who knows, a hangar, an airplane hangar. That's what you get. This is the reduction in volatility. You got an extreme ramp up, you got an overreaction down, and the key level of significance through it all, 5K, 5K, 5K. And this is proving very interesting. And you've been squeezing on the 5K as we approach options expiry.
Gold's $5,000 level is emerging as the most critical technical battleground in today's market. According to Francis Hunt, this round number represents a powerful midpoint between $1,000 and $10,000 and aligns with the 50% Fibonacci retracement from the 5,600 high to the 4,402 low. As options expiry approaches, volatility compression around 5K signals potential pegging activity in derivatives markets. Hunt's volatility funnel method highlights a volatility squeeze pattern resembling a triple bottom structure. With price grinding higher on declining volatility, gold appears poised for a decisive move above $5,085 resistance. Let's get back to the interview.
When you talk about options expiry and pegging levels and a lot of things like that, what tends to be most significant in all of that? Well, who's the main player? Who does derive markets? Why is the underlying being dictated to by the derivative? Well, the derivative market is bigger. In short, what is going on and what they're actually saying is far more powerful and enforced on the market than the underlying. So they will move the underlying to match their needs. This is the manipulation theory that many of us subscribe to, is certainly taking place to varying degrees. So then you get to the point, well, is it being manipulated up or is it being manipulated down? So if you're of the view that there might be some degree of manipulation constraining something from going up or holding something up that should go down, like the debt markets, hello, US treasuries, the dollar, yep, like those things being held up, Japanese debt being held up, debt as a whole being held up, HYG, the junk debt, the junk ETF, high yield debt, all being held up, all largely nearly bankrupt, paying terrible returns and likely to go bust the minute they don't hold the Ponzi together anymore. If there wasn't these actors holding it all together for you. And what do they do in the other sense? They need to suppress real money, gold. So if you are of that fundamental view, once the option expiry has gone, if something has been held down and no longer has that urgency, the expiry is gone, everybody pays out their bonuses or takes their beatings or gets their profits paid in on the option expiry. What happens if they then stop for a while? They have breathing room for 3 more months. If it was held down, it should go up. If it was being supported and they no longer is the same requirement to support it and it can relapse to a little bit of price discovery, the debt market, for example, would fall down and the rates would climb. So you've got to come to your own conclusions as the pegging moment passes, where everyone is kind of okay with 5,000 and now it looks like it's going to close probably to the high side. There could be some volatility. They might try push it backwards and forwards, or they've already accepted this is where it's going to be for the closure of the cash markets in the options markets in terms of what the underlying is. So they will push it around if they need to on Monday, Tuesday, and today in lieu of it, and it will get more intense. This is why you are getting low volatility. And low volatility is our game. We love low volatility because low volatility begets a sudden and violent expansion. Here was a small example of a low volatility compression. What happened next? Like that. And then massive down, massive up, and a massive expansion in the volatility, in fact. So you can see an increase in volatility and violent moves, asymmetric violent moves. If you'd had to take profit, you would have locked in a lot of profit here. And if you had to stop, you would not have been hurt, even if you failed to take. If you don't trade with stops and are taking leverage trades because you're following someone on YouTube and you think that's the game, then you're going to get wiped out. Anyway, we won't go down that hole again. I'm sure anyone with half a brain cell is now owning their own outcomes and not leverage trading, or someone off YouTube, for which he has only a certain amount of commitment to be able to update you. Anyway, that is it. So that's our squeeze within a squeeze, and it's very interesting.
Debate continues over whether derivatives drive the underlying market or simply reflect it. In major centers like New York City and London, options expiry often concentrates liquidity around key pegging levels, compressing volatility. Some investors argue large players influence prices to protect derivative positions, especially in markets such as U.S. Department of the Treasury securities or high-yield ETFs like iShares iBox Dollar, high-yield corporate bond ETF. When expiry pressure fades, suppressed assets may rebound while supported assets slip, triggering sharp volatility expansions. Low volatility frequently precedes violent breakouts, rewarding disciplined traders who use stops and avoid excessive leverage. Share your thoughts on his analysis in the comment section below. If you find this video informative, please support us by turning on notifications to stay informed about our latest videos. See you in the following video. Thanks for watching.